Welcoming on board right now is Mr. Rajesh Bhatia, the CIO at ITI MF. Rajesh, hi. First up, wishing you a very happy Diwali. May the next year be very prosperous for you and the entire ITI team.
Thank you so much and wish you and your viewers a very, very happy Diwali.
Great to hear that. But do you expect the next summer to be as bright and prosperous as the year gone by? Because as we stare at things right now, Jeffries is talking about how the pace of downgrades has been higher. Earnings haven't really picked up. Festive season is a bit muted. Does that tell you that the next year is going to be a lot more turbulent than what the summer 2080 was?
Well, we are still in a bull market. Having said that, I think there are two important components to what is evolving. One has been that, look, we have done extremely well as an equity market. The last 6 quarters have been positive. It's only in October that we have started at a new high, that we have started to kind of consolidate or decline a bit. And that is thanks to a slowdown that we are experiencing. And I think the results at the peak of the market are nothing to talk about. In fact, they were quite weak. So you had a slowdown at the peak of the market, and because of which now that there's an earnings cut. So the markets still are at 21 times earnings, which is still, I would say, slightly on the premium side. So at best, I think from a domestic perspective, it looks as if we will repair ourselves into this slowdown, which will take some time. And given that context, I think the markets will consolidate from here on in terms of time correction or maybe some sort of a price correction. That is the domestic context. The second context has been the FIs, which have been relentless sellers. Now, earlier we would have thought that the FIs are selling because of the, switching from an expensive India to a very cheap China. Then we thought that the FIs are selling because of, the tensions in the Middle East. But actually, the more important reason why FIs are selling is really the rise in the 10-year bond yields in the US. There is some apprehension that the economy in the US is still very strong, and the election that is to come, if that were to expand fiscal or keep fiscal as it is, it would be inflationary, and that would mean bond prices going up. That's negative for equities. So there are some election-related issues in the US which can have policy implications, geopolitical tensions, etc., which is what the markets are or FIs are very apprehensive about, and that's why they've been selling with such conviction. So those are the two things that we have to contend with in the market. But net, we are still in a bull market, but I think we should wait for a time or a price correction for the next 6 months or so. We are not going to see a new high very quickly.
Okay, not anticipating a new high for sure, but at an index level alone, Rajesh, we've already fallen 8% odd. I mean, how much more of a correction do you think is left in the pipeline?
That is a little difficult to gauge. Look, the earnings cut itself has been around 8% or so for this year, and we have corrected by 8%. So actually, in terms of valuations, we haven't really corrected as much. And what you could say is that it's very unlikely that we will rise significantly from here, given the slowdown that is in front of us that needs to repair itself. How it will pan out in terms of price correction, I think we have to wait and see. Look, we have also had these similar challenges starting October 21 to March 23. We had interest rates go up dramatically in the US, but in spite of that, what the Indian markets did was just consolidate in terms of price time correction. There was hardly any price correction even in the October 21 to March 23 period. So maybe we could see a repeat of the same. There is a time-wise correction that we see, but how much of a price-wise correction takes place is very difficult to gauge.
Right, morning. So, Rajesh, just given that it is the festive occasion and auspicious of Diwali, want to know, going into the next Samvat, which would be the theme that you believe could really light up investors' portfolios?
See, I still believe that large cap is a good place to be in because the valuations there are more reasonable. I would say the private banks have done quite well and the valuations there are comfortable. The largest private sector bank is repairing itself and it will probably be poised for growth in financial year 27. The second largest private sector bank is also actually a very consistent performer. So as far as private banking is concerned, private banks are concerned, I think that's a good place to be in. I would say telecom, insurance, capital goods, etc., domestic pharma, all of these are very good places to be in, especially in the large caps.
Okay, so that's a take coming in as far as where large caps are placed clearly right now. But within financials, Rajesh, if I had to dig deeper and ask you, private versus PSU versus lending, that is the NBFCs, what really would be the pecking order?
So for me, at least, it's definitely private sector banks first, because I think they are more solid business models and relatively better predictability of earnings. Second would be select NBFCs, and the third would be PSU banks.
Point taken on that one. And what's the view on FMCG and consumption as a whole? Because there was that talk of rural recovery hasn't really materialized to that extent, but urban seems to be slowing down, and that's the big concern now. With in that, putting that in context, what would you do with not only the staples but also discretionary, like let's say durables or the urban consumption themes, the likes of tourism, hospitality, luxury goods that were doing well?
Well, there's too much effort to very little reward ratio in the consumer businesses. I think we've been calling for an upturn in staples for the last 2 or 3 years, but that is not happening. And maybe I don't know, there is some talk of a structural issue with some of these companies to grow at an attractive rate. Be that as it may, and that's an argument that can be debated. But given where the valuations are and given the type of earnings growth that these companies are exhibiting, there's very little reason for us to kind of move significantly into these areas or try to preempt any upturn that takes place. We'll let the evidence come and we'll see whether we want to be in these spaces. Look, this is a capital expenditure cycle. If you look at the context of the past, the 2003 to 2008 was a capital expenditure driven cycle. The 2009 to 2020 was a consumption driven cycle. Since 2020, again, it's a capital-driven cycle, capital expenditure-driven cycle. So I think there are a lot more opportunities on the capex-driven cycle space rather than the consumption space. So that's really where our area of focus is, and that's where we are looking for opportunities.
Rajesh, your thought on banks, which you were just highlighting, what makes you bullish? Is it more because of valuation comfort being in perhaps this only pocket, selectively though now? Or would you say that there is merit in believing that credit and deposit growth actually will bottom out from this quarter?
Well, if you're bullish on the GDP of the country, which is, real GDP of 7.5%, it's very likely that over a period of time, credit growth will also follow. Then you have to look for spots where you're comfortable with the risk management DNA of those lenders and where there can be greater comfort in terms of cost of capital, etc. I find that given that context, the private sector banks are in a much better place. Like I pointed out, the largest bank, private bank in the country, had to digest a very large acquisition and it had to repair itself. I think a lot of the repair work is getting done. And I would think that it would accelerate starting financial year 27 onwards. Given the valuation comfort that we have on those kind of banks, I would say that that's a reason why we're gravitating towards these private sector banks.
Right, and what is the outlook when it comes to the potential of AI and the kind of disruption we can see for IT and tech companies? How is it that you're looking at playing this theme?
So I don't think AI will disrupt the services business of Indian IT companies. There are enough experts who from the industry who have kind of pointed that out. Of course, it will mean greater productivity increases because you may not require as much work as you did earlier thanks to the AI technology. Having said that, I think the Indian IT services companies will have to move up the value chain in terms of the solutions that they offer and in terms of skill sets they bring to the table. But it's not disruptive in that sense that this will take away business away from them, just that they will have to reorient themselves.
They'll have to reorient themselves. But Rajesh, what about pharma? That's one sector that has managed to report good set of earnings for the last 2-3 quarters. There's that entire Biosecure Act potential, and then the US FDA issues for at least a few of the companies seem to be getting sorted out. What within pharma looks good to you?
So domestic pharma has been a consistent performer. I would believe that companies in the specialty pharma business, which are exporting to America, etc., are also very strong business models because you make really fat margins there. The CDMO companies are also a very big opportunity. So I would say in all, if you look at pharma, Actually, in the last 12 months, the pharma sector has outperformed the market by a significant margin. In fact, I think the stocks are up about 40 to 50%. They may not follow the same pace, but on a multi-year basis, all of these business models that I've just pointed out, domestic pharma, specialty pharma business in a global context, CDMO companies, API manufacturing, all of that hold multi-year potential.
Appreciate your time. Thank you so much for joining in and sharing with us your outlook on the markets.
If you like this video, then like, share and subscribe to ET Now.